Over the last 2 decades, target date funds have increased in popularity among investors. Target date funds are especially prevalent within 401k plans, as they are often promoted as a set-it-and-forget-it investment solution. According to the Investment Company Institute's 2023 Fact Book, there are over $2 trillion invested in target date funds, the vast majority of which are within 401k plans. In fact, 60% of 401k participants hold a target date fund. For those unfamiliar with how target date funds work, let's quickly review. Target date funds automatically rebalance the asset mix between stocks and bonds based on a preset time frame. Investors typically pick a target date that coincides with their anticipated date of retirement. The closer one gets to retirement, the less equity exposure the fund will have. The appeal of target date funds is that they help simplify managing and rebalancing the portfolio. The portfolio rebalancing responsibility belongs to the fund manager, with no action required by the individual investor. We think there are several important issues to consider when thinking about investing in target date funds. Most investors would reasonably expect target date funds with the same target date to have roughly the same asset mix. But our experience shows funds with the same target date can have significantly different asset allocations. For example, let's look at 3 2025 target date funds from 3 well-known companies: Vanguard, Fidelity, and Dimensional Fund Advisors. As you can see, the asset allocations of these funds vary significantly, even though each fund has the same stated target date. Why is this important? You may be taking on more or less risk than you think you are. Here are several other drawbacks to using target date funds. One size doesn't fit all. Just because you retire in 2025 doesn't mean you should have the same portfolio as someone else retiring in 2025. There are myriad considerations involved in determining your asset allocation. What's your income going to be in retirement? What are your expenses going to be in retirement? What's your tax situation likely to be in retirement? These are just some of the variables to consider, and we think it's important that your asset allocation factors all these into your specific asset allocation. Expenses matter. Most target date funds utilize a fund-of-funds strategy. This means that the target date fund is comprised of other mutual funds. You need to make sure that the fund provider doesn't charge 2 layers of fees: one fee for the target date fund and additional fees for the underlying fund investments. Don't be too conservative. A 65-year-old couple retiring today has a 50% probability that at least one partner will live to age 95. The biggest mistake we see with do-it-yourself investors is being overly conservative. Far too many target date funds reduce the equity allocation to 20 or 25% at the targeted retirement date. For most people, this is far too conservative an asset allocation to allow you to maintain purchasing power over a 30-year retirement period. It's important to remember that using target date funds doesn't relieve you of the importance of monitoring your asset allocation. Don't assume because you pick a target date fund that you can simply leave it on autopilot. If you'd like to learn more about how we can customize an asset allocation just for you, we invite you to give us a call.